Okay, let's unpack this. It is Tuesday, January 27, 2026.
Hmm.
And if you have been anywhere near a stock ticker today, or just, paying attention to the business news, you know that General Motors has just dropped a massive earnings report.
Huge one.
We are talking about their Q4 and full year 2025 numbers.
And honestly,
Okay.
it is a fascinating document. It is essentially a Rorschach test for investors.
A Rorschach test. How so?
Yeah. I mean, depending on which page of the report you were looking at, you were either seeing a company that is absolutely printing money,
A total cash cow.
or you were seeing a company that just set a massive pile of cash on fire and is scrambling to fix it.
That is exactly the vibe I got. I mean, look at the headlines first. They beat Wall Street expectations.
They did.
Earnings per share came in at what, $2.51 versus an expected $2.21.
Right. And they posted, and this number is just staggering, $12.7 billion in adjusted EBIT for 2025.
That sounds incredible, but then you turn the page and there's this ugly, eye-watering number.
Yeah.
A $7.6 billion hit on EV restructuring.
It is a lot to digest. And frankly, that is our mission for this deep dive. We aren't just going to read the balance sheet lines.
Right.
We need to figure out how these two realities can even exist at the same time. How does a legacy automaker like GM navigate what is, let's be honest, a chaotic regulatory environment?
So chaotic.
Dealing with tariffs, managing a cooling EV market, all while trying to convince us they are actually a tech company.
Because on one hand, they have the profits of a legacy truck company, and on the other, they have the write-downs of a failed Silicon Valley startup.
That is a harsh way to put it, but not entirely wrong.
So where do we even begin with a beast this size? We've got robots, we've got write-downs, and we've got a surprising amount of resilience.
We have to start with the cash.
Okay.
Because despite all the noise about electric vehicles and the future, the core business, what they were calling the icy fortress, is performing exceptionally well.
Let's talk about that ICE fortress. That stands for internal combustion engine for anyone who hasn't had their morning coffee yet.
Yeah.
Basically, the gas cars.
The gas cars are carrying the load. Mary Barra, the CEO, called 2025 an exceptional year, and the math, backs her up. That $12.7 billion in adjusted EBIT was at the very high end of their guidance.
Can we pause on adjusted EBIT for just a second? We hear this term thrown around constantly. For the non-CFOs listening, why does that number matter more than just, say, net income?
Sure, EBIT stands for earnings before interest and taxes. When you see adjusted, it means they have stripped out all the one-time weirdness.
Like legal settlements or things like that.
Exactly. To show you the health of the actual operations, it's the profit from building and selling cars. And at $12.7 billion, that engine is humming.
And it's not just profit, it's cash in the bank, right?
A lot of it. They ended the year with $21.7 billion in cash sitting in the bank.
$21.7 billion. That is a serious war chest, and they aren't just sitting on it. I saw they authorized a new $6 billion share repurchase program.
And bumped the dividend.
By 20% to nest zero on 18 cents a share.
That is a massive confidence signal.
Okay, but I have to play devil's advocate here. If I am an investor, sure, I love a buyback. It pumps the stock price. But if GM is supposed to be pivoting to this high-tech future,
Right.
building robots and batteries and AI, shouldn't they be spending that $6 billion on R&D instead of giving it back to shareholders? It kind of feels like they're cashing out rather than investing in.
That is the eternal tension, isn't it? But look at their free cash flow. This is the key metric.
Okay.
5 years ago, GM's free cash flow generation was hovering around, maybe $3 billion?
Right.
Now, it is moving into the $10 billion range.
So they have enough cash to do both.
Exactly. This isn't just luck, it's operational discipline. They are running a tighter ship so they can fund the expensive future and pay the shareholders today.
Right.
That's a luxury very few companies have right now.
And a big part of that tight ship is trucks and SUVs, I'm guessing.
Absolutely. They achieved their highest U.S. market share in a decade. They led the industry in full-size pickups and full-size SUVs.
Which is impressive given how competitive that space is. I mean, everyone has been predicting the death of the massive SUV for years, and yet, here we are.
The market wants what it wants. But it's not just the $80,000 trucks. Did you catch the note about the Chevy Trax?
I did. It made Car and Driver's 10 best list for the third year in a row.
That is actually a really important detail. The Trax is an entry-level crossover.
Okay.
It proves GM isn't just winning on brute force or luxury. They're winning at the affordable end of the market, too. They are putting out a product with styling and technology that people actually want to buy, not just because it's cheap.
And they aren't cheating to get those sales right. I remember the old days where automakers would just flood the dealer lots to fluff the numbers.
Not this time. Their inventory is lean, about 48-day supply. That is the sweet spot.
And incentives.
They remain low. They aren't having to put thousands of dollars of cash on the hood to move the metal. And that preserves margins.
So the old world gas business is booming. But now we have to address the elephant in the room.
The electric elephant.
Yes, that $7.6 billion write-down.
Yes, the write-down.
I mean, when I see a company writing off nearly $8 billion, my knee-jerk reaction is disaster.
I get that.
They discontinued the Bright Drop electric van. They are shifting the Orion assembly plant from EV back to gas. Be honest with me, is the EV dream dead at GM?
No.
Oh.
And I think it is dangerous to interpret it that way, but disaster isn't the right word.
What is?
Sobering.
Yeah.
That's the right word. This is a reality check.
Okay, let's unpack that. How is losing $7.6 billion anything other than a failure?
Think of it as cleaning the decks. That $7.6 billion charge, taken in the second half of 2025, covers the cost of discontinuing Bright Drop and retooling Orion.
Okay.
By taking that hit now, they are cutting their fixed costs for the future.
Yeah.
They explicitly stated they expect EV losses to be lower in 2026 because of these moves.
So they're admitting the demand isn't what they thought it would be.
They're admitting the demand curve for EVs is flatter than they thought, and they are adjusting their spending to match reality.
So they aren't quitting EVs, they're just slowing down.
Exactly. Mary Barra had a very telling quote in the earnings call. She said, "We know EV drivers don't often go back to IC.
Mm-hmm.
They brought in almost 100,000 new customers to GM via their EV portfolio last year. They know the transition is happening, but they need to get the cost right."
And getting the cost right brings us to the batteries. I saw a mention of something called LMR battery chemistry.
This is the holy grail they are chasing. LMR stands for lithium manganese iron phosphate.
That is a mouthful. Why should I care about manganese?
Because of what isn't in it. Standard batteries today use a lot of nickel and cobalt.
Which are expensive.
Expensive, they have volatile pricing, and the supply chains are tricky. LMR chemistry cuts those costs significantly. They expect to launch this in 2028, and the claim is that it will reduce cell costs by several $1,000s per vehicle.
Several $1,000s per car. That is pure margin. It is the game changer they are waiting for. Until they can get the battery costs down, profitability on EVs is grueling. So the strategy is pull back on volume now. Stop the bleeding.
Stop bleeding cash on expensive current-gen batteries and wait for the better technology in 2028.
And in the meantime, they threw us a bone about hybrids.
They did. They briefly mentioned they are looking at hybrids in key segments. It's an acknowledgement that the market isn't going purely electric as fast as everyone predicted. Hybrids are the bridge.
So gas pays the bills today, hybrids bridge the gap, and cheaper batteries win the future. It sounds logical, but there is a massive external threat looming over all of this.
The trade war.
We are in the middle of a trade war. How does a global manufacturer survive when tariffs are flying everywhere?
It's a huge question. In 2025, GM faced gross tariffs of $3.1 billion. That is a massive bill to pay just to move parts and cars across borders.
That wipes out a huge chunk of profit,
Right.
but the report says they didn't actually pay that full amount.
This is where the operational agility comes in. They call it their self-help strategy.
Self-help. That sounds like they are reading a guru book.
It laughs. It's corporate speak for fixing our own
Yeah.
problems. They managed to offset over 40% of that $3.1 billion cost.
Wait, how do you offset a tariff? Do you just ask the government nicely not to pay it?
I wish. No, it's about go-to-market actions, footprint adjustments, and, well, supply chain Tetris.
Okay.
Basically, if a part coming from country A has a 25% tariff and country B has 0%, you move your supply chain to country B.
Or you just build it here. Is this related to the onshoring they talked about?
Precisely. They are aiming for an industry-leading 2 million units produced annually right here in the U.S. By building the cars where they sell them, they insulate themselves from political risk and trade wars.
And they expect tariffs to get worse.
They expect gross tariffs to be even higher in 2026, $3 to $4 billion, but they plan to continue these mitigation strategies to keep the net impact lower.
That is what I mean about resilience. It feels like they are doing tariff judo, using the momentum against the opponent.
That's a great analogy.
Yeah.
And it's necessary because the regulatory environment is, frankly, chaotic.
Okay, so we've covered the money, the cars, the politics. Now I want to get to the part that really got me excited.
The robots.
The robots. I knew you would latch onto this too.
Of course.
I mean, come on. It felt like reading a sci-fi novel. They aren't just building cars, they are changing how they build them. They talked about this predictive weld quality model using AI.
This is part of their argument that they are a tech company, not just a Rust Belt manufacturer.
So how does predictive welding actually work?
Think about how welding usually works. You weld a frame, and then maybe you inspect it later, or you spot check 1 out of every 100.
Right, and you might miss a bad one.
You might not find it until the car is down the line, or worse, in the customer's driveway. GM is using AI to monitor the voltage, the heat, the resistance of the weld as it happens.
So the robot knows if it made a bad weld instantly.
Correct. Which means 0 bad welds leave the station. It improves quality, but it also saves a fortune. They expect a $1 billion benefit just from warranty savings.
Because better cars break less.
That goes straight to the bottom line.
And then there are the cobots.
Cobots, collaborative robots designed to work alongside humans.
The visual they gave was so cool. A robot picking up a heavy exhaust system and positioning it perfectly so the human operator can just bolt it in without straining their back. It's like having a super strong assistant.
And it's controlled by GM's own software. This is key. They aren't just buying off-the-shelf solutions, they are integrating this into their own software ecosystem.
And that software ecosystem is where the real future money is.
The subscription revenue, the holy grail.
Recurring revenue.
Yep. OnStar reached 12 million subscribers. But the star of the show is Super Cruise.
That's their hands-free driving tech.
Right. It grew nearly 80% year over year to 620,000 subscribers. That is high margin revenue.
Once the software is written, every new subscriber is almost pure profit.
Exactly. They expect deferred revenue from software and services to hit $7.5 billion by the end of 2026.
$7.5 billion. That isn't a side hustle anymore. That is a Fortune 500 company inside of a car company.
And it's only going to get bigger. They tease the eyes-off, hands-off driving technology launching in 2028 on the Cadillac Escalade IQ.
Eyes off. That is a scary and exciting phrase. There is a big difference between hands-free and eyes off.
Huge difference. Hands-free means you still have to pay attention. Eyes off means you can check your email, read a book, watch a movie.
Wow.
It requires a massive leap in technology and trust. They were talking about a new software architecture with 10 times more over-the-air capacity. Basically, the car becomes a supercomputer on wheels.
So I can just sit back and let the Escalade deal with traffic.
That is the promise.
Yeah.
And people will pay a premium for that time back.
Now, before we look at the guidance for next year, we have to touch on China. For the last few years, the headline has been, Western automakers are getting crushed in China. I honestly expected them to announce a retreat. But GM is singing a different tune this quarter.
It's a surprising turnaround, isn't it? GM is reporting that their China portfolio is profitable across price points.
Profitable.
And the statistic that really stands out is that new energy vehicles, NEVs, are now about 50% of GM sales in China.
Wait, so half the cars they sell in China are electric or hybrid?
Yes.
So they are actually competing with the local Chinese manufacturers.
It seems so. They've adopted a strategy of in China for China, tailoring their products specifically to that market. It proves they can compete if they stop trying to sell American cars to Chinese buyers and start building what the local market actually wants.
That is a huge relief for investors who were probably ready to write off the Chinese market entirely.
Agreed. It turns a liability into a stable, if not growing, asset.
So, putting it all together, what is the forecast for 2026? What are they telling us to expect?
The guidance is strong. They are forecasting adjusted EBIT of $13 to $15 billion.
Which is potentially higher than their record 2025.
It is. And crucially, they expect North American margins to return to the 8–10% range.
Which is the gold standard for them.
It is. They have headwinds, of course. Commodities are getting more expensive, aluminum, copper, and the onshoring costs money up front, about $1 to $1.5 billion.
But they have tailwinds.
Massive tailwinds, like those lower EV losses we talked about.
And the warranty savings from the AI quality control?
Exactly. And they are launching new trucks.
Of course they are.
Next-generation full-size pickups. And for the enthusiasts, the 6th-generation small-block V8.
Long live the V8. It is ironic, isn't it? We spent half this deep dive talking about eyes-off autonomous driving, AI robots, and battery chemistry.
And they're also launching a brand-new gas-guzzling V8 engine. It captures the duality of GM perfectly.
They're milking the cash cow to feed the calf.
They need that V8 to pay for the AI.
So let's wrap this up. If you had to synthesize this report into a single takeaway for our listener, what is it?
I would say GM is essentially funding a high-tech startup AVs software, advanced batteries, using the massive profits from a century-old truck business.
Right.
They are cleaning the decks with those write-downs to run leaner. It's a masterclass in adaptability. I mean, they're using AI in welding, shifting production lines overnight to dodge tariffs, and managing global trade wars, all while keeping the stock price happy.
It really is impressive. It's like watching a massive ocean liner turn like a speedboat.
But, and here's the provocative thought I want to leave you with. It's a race against time.
Casso.
GM is betting the farm on a 2028 future. That's when the cheap LMR batteries arrives. That's when the eyes-off driving arrives. That's when the software revenue really scales.
But until then,
Until then, they are relying on gas trucks to pay the bills. So the question is, can they keep the old world profits flowing long enough for the new world tech to be ready?
exactly. If the gas truck market collapses before 2028, or if the tech is delayed, that bridge they are building could collapse right out from under them.
That is a high-stakes gamble. But if 2025 is any indication, they seem to know how to play the hand they're dealt.
They certainly do.
Well, that is all for today's deep dive into General Motors. Whether you are driving a V8 Silverado or waiting for that autonomous Escalade, thanks for listening. We'll catch you on the next one.